So there's two stocks that hit 52-week lows that I definitely been keeping an eye on, and it's been an interesting close to last week as we saw SaaS companies really hit the dirt. I mean, companies like Salesforce, Workday, and PAYCOM. Now, PAYCOM is a SaaS business, provides cloud-based human capital management. It basically takes employees from the onboard hiring process all the way down to retirement, and specifically works with small to medium-sized businesses. And as we all know, the small and medium-sized businesses are the ones that are really having a hard time navigating the higher inflation, the higher wages, and running a business efficiently in this market. And so PAYCOM has definitely taken a massive hit recently. And along with Friday, sold off with a lot of the other SaaS businesses. Now they have their own problems taking place here. Number one, I thought the valuation was fairly high at one point for PAYCOM, but at these levels, I definitely think it's interesting. But also, there has been a rearrangement of management taking place as well. Now, this was a stock trading for over $540, now trading for $145, sitting under a $9 billion market cap. And this is where I think there is fear in the streets, and this is the time to possibly get greedy on these types of companies. And this may be the time to get greedy on a company like PAYCOM. Along with PAYCOM, we also watched Bristol-Myers Squibb hit a multi-year low. Now, Bristol-Myers Squibb has been quietly acquiring companies over the last few years. So we're going to get into Bristol-Myers Squibb, we're going to get into PAYCOM, and see if there's any underlying opportunities here. So on the recent quarterly report for Bristol-Myers Squibb, I really want to point out something that is a little bit alarming here. When we look at their net debt position, it's definitely becoming concerning here. They had $27 billion of net debt, now over doubled at $45.6 billion of net debt. But when we factor in all the recent acquisitions that they have made and the recent fall of the price, you're essentially buying Bristol-Myers Squibb and getting a lot of these acquisitions for free. The question becomes, where do earnings go from here? Now, I updated my model with my projections and what I think the company is capable of doing, and I think anything around $40 here is a very, very good value for Bristol-Myers Squibb. We factor in that they have nearly a 6% dividend that I think is going to be safe over the next year, and especially if earnings start reaccelerating, this dividend will be intact. The question becomes, what does 2025 and 2026 look like for Bristol-Myers Squibb? Unfortunately, none of us really know, but we can go off of what they're projecting here. So when I look at the sentiment of Bristol-Myers Squibb, we have a low of $43 and a high of $84, which could mean that there's some value here. But where I want to stay focused is, where do we think projected earnings are going to go? On stock analysis, they have them finishing out the year around 57 cents of earnings, with reacceleration of 2025 and 2026 getting back to $5 to $6 worth of EPS. Which means that if we're buying the stock today, we're essentially buying it for a single digit EPS. And so we compare that to their peers trading around 19 to 20 times on a forward basis. If Bristol-Myers Squibb can do anything between $4 to $6, it absolutely makes it a steal when we put a market multiple on it. I mean, even if we put a 10 times multiple on $5.50, we have a $55 price target for Bristol-Myers Squibb. And that's not including buying it today and getting that nearly 6% dividend yield to go along with the capital appreciation that could take place as long as earnings get back on track. Now, from a cash flow standpoint, this is a company that does anywhere between $10 to $15 billion of free cash flow. And so as long as the fundamentals get back underneath this company, I do think they'll be able to handle this debt load. The icing on the cake is going to be, with the recent acquisitions, are they going to get any more revenue growth and any more margin expansion that the market may be overlooking here? And so anything around $40 and below, I do think you're going to outperform the market with dividends reinvested, which makes Bristol-Myers Squibb an interesting buy, but definitely has its risks when we look at the balance sheet. Now, I personally don't own Bristol-Myers Squibb in my portfolio. I have a heavy position in Pfizer and CVS. But if those start outperforming and Bristol-Myers Squibb is still underperforming, I'd be interested to take some of those profits and diversify into Bristol-Myers Squibb. I'm basically building a healthcare portfolio at this point in time, but I truly believe that's where we see the biggest opportunities right now in the market. When I kind of look at what's been taking place, it's been harder and harder to be a stock picker in this market as valuations are getting stretched. But definitely one of the areas that intrigues me the most is going to be that healthcare sector. Because if we do go into a recession, healthcare earnings usually stay pretty resilient. And it doesn't hurt that a lot of these companies are paying pretty fat dividends right now. And I definitely think Bristol-Myers Squibb is going to want to keep paying this dividend as it's been paying it for 34 consecutive years and growing it over the last 7 years, which makes this one a very powerful compounder, which is now going to lead me to PAYCOM, a position I did add in my portfolio. And I do think it's a pretty high risk here. Let me explain why that is. This stock was trading for over $540 a share, now trading at $145 a share, and that's about where I got in. Just a small position here. I think this is a very interesting way to play small and mid-cap companies and have a company that has a very good balance sheet and a pretty interesting business model overall. Their bread and butter is dealing with smaller and mid-sized companies. So when these companies explode and start growing, well, PAYCOM's going to benefit from that. And so essentially, by owning this company, I'm essentially owning a lot of high quality small and medium-sized businesses that are implementing this type of SaaS model into their own businesses, which means that they probably have some success here. It means that they're hiring, they're profitable. And so I do think this one is uniquely positioned, and I don't really own any financial companies. So this is a nice add to my portfolio. Now, in the short term, I do think there's some tremendous headwinds here, and I wouldn't be shocked if it actually got cheaper. We're starting to see small and medium-sized businesses have a lot of trouble navigating this market, as I stated before. When we look at sentiment around the stock, anywhere from $160 a share up to $427. Currently, the stock is at $145, which means, once again, there could be some upside here. A lot of experts have them growing right around 10 to 11% pretty consistently. So I think valuation's a little bit tricky on PAYCOM. When I look at it from a PE standpoint, it definitely seems like it's in line with its peers, trading around 18 to 19 times earnings. But where it gets a little bit more expensive is nearly on every other metric, and this is why I only started a small position. I basically think anything between $95 to $115 makes sense for PAYCOM. And so I did start a small position at 145, which is probably a reach here, but this is a company doing all the right things and could trade at a premium for a substantial amount of time until it grows into its valuation. I don't think this is a high flying valuation, but I still think it's a little bit overpriced. When we just look at the revenue and earnings growth from this company, it is absolutely a thing of beauty. But yet the price has gotten cheaper, falling from $540 a share down to $145. And this is where I do think it might make sense to take on a little bit of risk here. And when we look at recent price targets, it seems like most people think it's over a $200 stock. I still think it could fall closer to $100 a share. But I'm understanding my risk here and saying that we're taking on a small position and understanding that if it does fall into our ideal price target, we probably have to double or triple what we're looking at right now, which means if I put roughly $2,000 in, I'd have to be willing to add another $4,000 to $6,000 in this stock if it hits my price targets. When we look at revenue, just a nice upward trajectory, net income on the same path as well, and earnings per share is growing steadily. And what do we always talk about on this channel? Prices will follow earnings per share, but you have to know when to get in. And when we were valuing this stock around $300-400, it was definitely way above what we were willing to pay for it. When we were looking at $100 to $115 price target, as you guys can see here, I definitely reached a little bit at $145, and I could get punished for this. But I just think everything is nice and steady with this business, and this could be one that turns around pretty quick, especially if they re-excel on their top line revenue, which then will follow through EPS. Now, if they can do between $8 to $9 by 2025, I do think it would be an absolute steal here. So if we just use $8 a share, we multiply that by 18 times earnings, we get a $144 price target, which is basically what I'm paying right now for it. But if they can really accomplish 9 times earnings, we're looking at closer to a $162 price target. And this is a company that has implemented a dividend recently. Another reason why I'm willing to pay just a little bit more for this company is the way they deploy capital. Return on invested capital over 31% and return on equity over 33%. This company is doing a lot of good things here. The fundamentals look very strong. Within the company, they are dealing with some issues, and I do think small and medium-sized businesses have some big headwinds ahead. But this is a clean balance sheet. This is a company still growing, and I think the fundamentals are fairly strong. I do think I overpaid a little bit for it, but I want to have some skin in the game in case if they surprise to the upside. Hopefully you guys enjoyed 2 stocks that I think you can invest in for the future and that are definitely getting interesting. Now, I personally would like to see Bristol Myers Squibb somehow get back underneath $40 a share, and I would probably take profits at some of my other positions to slowly build into Bristol Myers Squibb. Now, PAYCOM is one that I added into very recently on Friday, And if this thing got closer to $100, and if this thing got closer to 95 to 115 a share, I'd probably be putting some real money to work in this one as well, as long as the fundamentals are still making sense. Let me know what you guys think in the comments about these two stocks, and we will see you in the next one.